Okay, ladies and gentlemen, I think we're going to go ahead and get started. It's the top of the hour. Today, we are going to be discussing the Chevron segment rates. The title of the presentation is, Am I Working for Free? We'll talk about that in a moment. Just brief introductions. My name is Brian Stormont. I'm one of the managing partners with Insight Wealth Strategies out of the San Ramon, California office. Presenting with me today is going to be Chad Seegers, also managing partner, only out of our Houston, Texas office. The purpose of today's discussion is to highlight the Chevron retirement plan or the pension plan and the implications of segment rates on the value of the lump sum. So when we were trying to come up with the title for today's presentation, the whole "am I working for free" question was a little bit tongue-in-cheek, but quite frankly, it's the number one question we're getting from a lot of people this year. And so we want to kind of dive a little bit more deeply into what goes into the calculation on the lump sum amount and how it works. But from just a very high level, one of the things that we can say is where interest rates rise, and by extension, the segment rates, which we'll discuss in a little bit, where they go up, in general, that could lead to a decrease in the lump sum value of the pension plan. And consequently, you could end up actually working for free. In fact, I'll turn it over to Chad. He's going to walk us through an example right now.
Thanks, Brian. So just a little hypothetical scenario. Let's imagine John works at Chevron. He's been there, 30 plus years, makes $150,000 a year. He's ready to retire when he turns 65 in July. And meanwhile, we're in an environment like we're in now, and interest rates are rising pretty rapidly. So when this individual commences his benefits on August 1st, and he elects to receive his CRP lump sum, that payment would be about 1.815. John isn't following segment rates, not really aware or too concerned with what's going on in the interest rate world. And so he doesn't know that segment rates affect this lump sum amount pretty severely in some cases. Consequently, had he commenced his benefits on May 1st, say his successor was ready, he could retire. He actually wanted to retire a little bit sooner. His lump sum would have been right at 1.852. So John earned about $37,500 in salary between May and July. And at that same time, with interest rates, the segment rates rising, he lost $37,500 in that lump sum value. This is where the idea of, quote unquote, working for free comes from. It's a comment that we hear from a lot of Chevron individuals. And this is us sort of laying out how that real life event occurs.
Now, all that being said, obviously, we don't want to be alarmist here. This is just one facet of the overall compensation package for Chevron retirees. And there can be a number of other factors that could mitigate any potential decline in the pension plan. So I want to just highlight those real quickly. So first and foremost, there's the prorated portion of the SIP. So to the degree that somebody stays through at least April 2nd, you're going to qualify for that year's prorated portion of the SIP, depending on how long into the year you stay. Clearly, if your pension plan were to decline by an amount that's commensurate with the SIP, that essentially offsets itself. Another couple of other factors in the compensation package that are important to note. So on the ESIP plan, obviously, you're getting an 8% match to the degree that you are participating in the 401k. And of course, here at Insight, we very much hope you are. And additionally, there's the health benefits, which cannot be discounted. So while you're working, the health benefits are quite a bit cheaper than when you transition over to the Chevron retiree plan, assuming you have obviously all your points to qualify for the subsidized retiree medical benefits. So this is not to say that there aren't other factors that could offset the pension plan. At the same time, though, we want people to be fully aware of how these various features on the pension plan come together, just so that they are as informed as possible on this. So with that said, let's take a dive into the segment rates.
So there are four main components of the Chevron retirement plan. You've got your age, years of service. How long have you been at the company? What is your income level? In the last determining factor of the lump sum is going to be the actual segment rates themselves. The first three factors determine what a single life annuity would be for any individual. And then they have to come up with a value of what someone should be paid if they elect to receive that via lump sum when they retire. And so this is, a basis for every pension plan in the United States. It's IRS determined segment rates, and they publish these around the middle of the month, 15th through the 17th. And we actually, track this within our firm. We send out a segment rate watch list, but it is essentially 3 interest rates: your first segment rate, second segment rate, third segment rate, all averaged together. Now, Chevron having a process for everything. You have the baseline IRS guidelines for what a pension should pay out based on segment rates. Chevron has a slightly unique feature with how their lump sum is determined.
Yeah, so with every pension plan, as Chad just alluded to, they need to utilize the IRS segment rates in the calculation of lump sum, but every pension plan also has a little bit of leeway as to how they want to implement those segment rates. And Chevron has an interesting process. So what Chevron does is they basically take a rolling 3-month average of the IRS segment rates to arrive at the calculation for a particular annuity commencement date, which is what they use to calculate the lump sum. So in the bottom right corner on this slide, you can see an example here. We've got a Chevron retiree that has a benefit commencement date of July 1st. Now, to arrive at the July 1st segment rates for segment rate 1, 2, and 3, Chevron is going to take the rates from the month of February, March, and April and average those out to arrive at that number. Now, in here is some opportunity for a little bit of gamesmanship, and this gets into the nitty-gritty of some of the conversations we have with clients around the timing on the lump sum. So let me give you an example. Let's say, as opposed to kind of what we're talking about right now, which is rates going up, let's say we're in a scenario where rates are declining. And so we have a February rate that's particularly high, and then March and April are quite a bit lower. This individual could still retire on the same day in June and be eligible for the commencement date of July 1st, but they could decide that they want to just sit on their paperwork and move it to August 1st commencement date. And in doing so, the February rate falls off, and here you have a 3-month average of March, April, and May. So again, understanding the direction with which the segment rates are moving, and then understanding how Chevron applies that 3-month average is a very important aspect in trying to maximize the benefit on the pension plan. Now, let's show you how Chevron calculates the 3-month average.
Yeah, so to Brian's point, if we take a look at the column here for the second segment, and you take a look at the average starting November at 272, then October 274, and then September 255. And then you have this ability for the 1-month look ahead, and you see that December number at 2.72. Well, you've got, a 0.25% jump that if you wait 1 more month to execute the documentation for the lump sum, you're then going to be in a higher interest rate regime. And so categorically, we know that interest rates are rising right now. As you start to fine tune what your retirement timeline looks like, this is another piece I would say is a value add that you could use to determine, 1 or 2 months plus. We've had people in the past that fully retired and sat on executing their lump sum documentation because, as Brian mentioned earlier, segment rates can also fall, and therefore their lump sum was also increasing in value. We have the ability, as you're tracking these numbers, for a little bit of a look ahead that tells you when you should be pulling the trigger. So how are these segment rates adopted and used by Chevron? It's complex. It's based on actuarial tables. Some of the factors that we looked at earlier, for argument's sake, you don't really need to go into that much detail. You guys have a segment rate calculator that you can use. I would caution and say, just be aware of some of the magnitude of changes that I see sometimes with people putting in. If you have some questions on what values you should be using with that tool that you guys have online, email, call us, let us know. We can run some stress testing for you with that tool. But the numbers are really dependent upon kind of 3 factors. You have your first segment, which is a sort of a third weighing in this lump sum calculation. And this, roughly equates to the first 5 years they'd have to pay you in the annuity. The second segment rate, second interest rate, sort of intermediate term interest rate, this is the big one. This is the biggest weighing factor in the calculation. And then you have your third segment rate, the third number to pay attention to that, it's sort of marginal. It's long-term payment of these income streams. And so the first and second segment, as you see, it's the lion's share of what's going to happen with that lump sum value. So how does this affect you? Why are we talking about this now? Well, we're in an environment where the Federal Reserve has made it clear through a tool they use called forward policy guidance, where they're telling the American people, we're going to begin raising interest rates. And so while they haven't done it yet, they likely will in 2 weeks. The interest rate markets themselves have already started to rise. And what you're looking at is a chart of the 10-year US Treasury yield. It's a pretty good proxy for all things in the interest rate world with a lot of spillover effects. And it's already come up a good bit with forecasts putting it, later on this year between 2.2 and 2.9, possibly on the upside. You've seen the spillover effect already in the mortgage markets. You saw mortgage rates go from 2.25 now up to 4. Corporate bond rates as well, which is what segment rates track, have already had some moves. What does this look like? If you're talking about Federal Reserve actions and the ultimate spillover effects, we had a Fed rate hike environment from 2016 to 2018. It's the last cycle that we went through. And so currently, best estimates are the Federal Reserve will hike interest rates in this orange box on the far right from 0 to about 2.25%. I think for anyone that says that they can predict how much this will spill over into the rest of the interest rate world, that's tough to say. As you see now with geopolitical events around the world, interest rates have come down near term. You have a lot of inflation expectations out there, which would indicate that interest rates would be higher at some point in the near term as well. So there's a lot of competing factors. It's not as straightforward as the Fed is raising interest rates and it has a direct effect tomorrow on what goes on. And so let's take a look at last 10 years. This is a little bit messy, but you have the orange line here. This is that last segment. It's about 10% of the calculation. Then you have the green line, which is your intermediate term. That's the biggest weighing factor in the calculation. And then the shorter term segment rates here in red. And so a good composite is this blue overlay. In the last time the Federal Reserve began raising interest rates like they're going to engage in now, that went from about 2.86 up to about 4.2%. And so it was a pretty significant move in interest rate world. And in a relatively short period of time, when we start talking to most people around retirement, 2, 3 to 5 years out is when they're starting to plan this. We do talk to those individuals that are 6 months out, and it's then optimizing, when do I do it? And that's really when segment rates get involved, frankly. To just dial in a little bit more on what happened in that environment, what you're looking at, the bottom line is the effective federal funds rate. And the step ups are when the Federal Reserve raised interest rates. And you can see the direct spillover effect into the first segment rate in blue, that meaningful segment rate in yellow, and then the last segment rate more or less stayed flat in that environment. At this time, the impact to the lump sum would have been a decline of about 9%. Also, things dependent upon that, obviously age, years of service, et cetera. So high level, a 1% or so move in the composite rates is about an 8 or 9% drop in the lump sum, depending on where you are. So this is just something to consider in the environment that we're in. As you start to look forward, at your future self 2-3 years down the road, every indication thus far is we're in for an interest rate hiking cycle for some time here, the next 18 months or so.
Yeah. So again, just to kind of bottom line it, again, depending on where you are in the age factor, that's a critical component. Certainly those years between 55 and say 60, the age factor really goes up quite a bit. And so As I mentioned previously, there are other components of the compensation package that could defray or lighten the impact of rising segment rates. The age factor is another aspect as well. So those critical years between 55 and 60, even if the segment rates are rising, because the age factor is going up, it may not have as much of an impact on the individual. But again, we take this on a very much a case-by-case basis. But at really high level, one of the things that we would say is really you should not use segment rates and the impact on the lump sum as the sole determinant of when you should retire. There are so many other factors that go into that. And so we're going to talk a little bit about kind of what we do here at Insight. While I do that, I'm just going to let you know if you do have questions you'd like to submit, feel free to enter them into the chat section and we'll see those and we can address them as we get to the tail end of the presentation. But here at Insight Wealth Strategies, we're a fee-only financial planning and wealth management firm. And with our Chevron employees, when they start working with us, on this diagram that you can see, the upper left quadrant is oftentimes hands down priority number one. And this is really, am I able to retire? What does my cash flow look like when I transition to retirement? Should I take the lump sum or should I take the annuity? It's not cut and dry. Obviously, quite a lot of employees take the lump sum, but there are certainly some good arguments to be made for why you might take the pension instead or the annuity payment. Benefits maximization through the company. So what do my retiree medical benefits look like? What do my benefits look like when I get to 65 and transition over to Medicare? Social Security analysis. When should I take that benefit? So these are going to be factors that we're going to work with our clients to determine when's an optimal time to retire. From there, we're going to expand the pie into other areas of the financial planning world. So we're going to talk about things like risk management. We're going to talk about items like estate planning. And here, just as a quick aside, certainly if you're in the state of California, you ideally want to have your estate plan documents, because California probate is not a pleasant process. And if you are a Chevron employee participating in the supplemental life insurance program, a lot of employees don't know this, but you actually have access to a very nice discounted attorney program through the MetLife benefits. And there you can access local estate planning attorneys who will help you draft your wills and trusts and powers of attorney at a very, very discounted rate. It's a wonderful program. We would be certainly happy to answer any questions and maybe even connect you with attorneys in the area that participate in that program. And then in the bottom left, bottom right quadrant, then there's really the wealth management side of things. So investment management, what's the proper structure of my portfolio if I am no longer in the accumulation phase of building the pile of assets, but now I've retired, I'm in the distribution phase. What are tax strategies I should be thinking about? To the degree that I'm eligible for LTIP, how does that factor into my cash flow and tax planning analysis? So these are going to be all the facets that we're going to bring into the conversation with our clients. One of the things that we have in our arsenal of tools is some wonderful technology to help our clients do this long-term analysis. And as I'm sure Chad would happily attest, working with Chevron employees for a long time, we know there's a lot of analytical folks in the organization, and some of these tools they love quite a bit to play with. But this is an example of an individual where they're looking to retire in say 2025. And so in this example, we're actually modeling out a scenario where segment rates fall, and they decide to work through April 2nd, so at least through April 2nd, so they're qualifying for some prorated portion of the SIP. And what you can see in the bottom right corner is that the lifetime value gained by those two decisions adds nearly $500,000 to their net worth. And so this really exemplifies, I think, a really important component around retirement planning. And that's that you're looking across 20 and 30-year plus timelines. And small decisions can have magnified effects over that many years. So we want to make sure that we've identified all the little nooks and crannies of your financial situation and look for ways to benefit it. As an example, we'll go into a cash flow analysis with virtually all of our clients. And we're going to take a look at how do things look on a burn rate. When we say the word burn rate, we mean what's your withdrawal rate from the portfolio. We also want to take a look and see are there opportunities for some really nice planning on, say, Roth conversion strategy. So here, perhaps it makes sense to, in those years before Social Security benefits, before your required minimum distributions at age 72, perhaps we should be doing Roth conversions. There can be some really wonderful benefits to both you on a very long-term basis and even your beneficiaries that you may want to be aware of. So again, we're going to be able to explore all those different scenarios. We're also going to bring into the equation the Monte Carlo analysis. So here we're beginning to apply varying rates of return into the modeling, and it's then beginning to yield a probability of success. What's the probability that we are hitting our financial objectives? And so here, what we're going to then look to do is identify inefficiencies in your financial situation to then hopefully begin to improve that probability of success. And ideally, when we're talking about retirement, we really want to see a probability of success of about 80, 82% or higher before we say to somebody, hey, this makes sense. So these are going to be some of the tools that we're going to bring to bear in the analysis when we're working with a client. And obviously in that conversation, as you might be able to surmise, is the conversation around the lump sum and what the segment rates are doing and when's an optimal time to separate from the company. So with that said, I'm going to pause for a moment. And again, if anybody is looking to add any questions into the fray, feel free to enter that into the chat section right now. I know we do have a couple questions that have come in already. Chad, I'll let you field this first one. So how long will it take for Chevron to pay out my lump sum?
Great question. That's it's a when you leave process. Typically, if you retire anytime before the first of the month, your lump sum is going to be effective on that first of the month following. They've now made it to where you can get your documents electronically. You have to execute. If you're in the state of Texas, married, you have a spouse has to sign and notarize. Typically, what we do for clients is we prepare all those documents for you, mark them up where they need to be. You guys retire once. We've done it, a couple hundred times. Then those documentation, it's loaded up into the system, and then it's going to be paid out typically, the last day of the month after the month that you retire. It's typically via wire directly to an IRA. That's actually not a taxable event if someone does elect that lump sum. And so, if paperwork is not in good order, or invalid for some reason, you can unfortunately push that execution date forward. We have seen that occur, and so it's critical that you follow Chevron's process, obviously, to getting this stuff done correctly, because if not, you could find yourself in a different interest rate environment, obviously, down the road.
Yeah, no, that's a great point, Chad. Another question that came in is 20 years out too early to begin looking at segment rates? And I'll field that one. So here, I would say probably so. As I kind of alluded to earlier, the overarching question is, can I afford to retire at this point? So as an example, just a couple of years ago when EOI came around, we had a number of clients who came to us and said, hey, should I raise my hand and be left standing and collect that severance check? You know what? The reality was when we did the analysis, we determined that 1 year of additional salary just was not going to be sufficient to put them over the finish line in terms of being able to retire. For many of those individuals, we said, for better or worse, it looks like you're going to need to work for a number of additional years. Now, all that being said, certainly for our attendees who reside in California, as a current resident of California paying taxes, I don't like saying this, but we do get a lot of clients who want to explore a move out of California scenario. And quite candidly, that does move the needle quite a bit in people's ability to retire. So we do explore that. I would say for our California cases, probably at least 25% of the time, we're at least exploring the option to see what the impact would look like. So good question there, though. So yes, I would say probably a little too far out on a 20-year standpoint. Another question we got, Chad, is the tax impact on the lump sum. What does that look like?
Yep. If it's going from Chevron retirement plan to your own personal retirement account, wherever that may be, that's not actually a taxable event. If it's going from the Chevron retirement account to your checking account, for example, that is an absolute taxable event. You want to avoid that at all costs if you can. I see one in here, quick high-level example of a situation where the annuity could possibly be more favorable option. I'll just add, I know you have your answer to that, Brian. We saw an interest rate environment shortly after the financial crisis, shortly before the financial crisis as well, where the annuity made absolute sense to take versus the lump sum. It's, it's a present value calculation of future dollars coming in. Chevron's data and most pension data, more than 90+% of people are taking lump sums in this environment. It's not because they don't necessarily like the annuity, it's because the annuity is in a very good return on dollars versus what you could be paying if you're in an environment where that annuity is a guaranteed 8% return on dollars versus lump sum. You can't touch that anywhere else. And our advice would absolutely be to take it. There's some other scenarios where you see that are a little bit unique, where behaviorally it makes all the sense in the world for someone to take the annuity. I think that's unique to most people, though, individually.
Yeah, and I know just as a firm, one of the things that we do with our clients as we're going through that analysis is we go through a little bit of a decision tree with the individual and look at all the pros and cons of both the lump sum and the annuity. And of course, the annuity, there is certainly the peace of mind of knowing you've just got these systematic payments. You don't have to worry about it. There's no investment risk aspect to it. Whereas if you do take the lump sum, now you're responsible for managing or storing those assets. So it's not a simple decision. And certainly there's a variety of factors that go into it. And we certainly explore all those with our clients. Another question that came in just real quickly. So question of two things. So how much do you charge for retirement analysis, and are you a fiduciary? That's a really good question. So let me just highlight that in a couple of different ways. So first and foremost, we absolutely are fiduciaries. As registered investment advisors, we are held to the fiduciary standard by the SEC. Personally, as a certified financial planner, I'm also held to this fiduciary standard of the CFP organization. Past that, though, we at Insight are what's called a fee-only firm. And so what that means is we do not get paid to sell financial products. We don't receive commissions. There's really only two ways that we do get paid. Either we're creating a financial plan where we charge a flat rate to an individual that's a pre-agreed upon dollar amount, or we're managing assets at some percentage of that asset threshold. So to the individual asking about how much we charge for retirement analysis, realistically, that's going to vary. It really depends on the scope of the amount of work going into it. So I don't want to identify a specific number. What I would say is, if you're thinking that might be something you want to explore, I would argue have a sit down with one of our planners. Our process is very low key. We're not here to try to, pressure someone to buy a timeshare or anything of that nature. We're really just looking to identify clients who want to partner with us and work with us. And if it's a fit, great. If not, no big deal. I'm certainly, I feel quite confident that even if it doesn't work out in terms of building a relationship from there, you're probably going to learn something pretty good about the planning process and the Chevron benefits. So yeah, I would encourage you to reach out and maybe schedule a time to sit down. Again, our process low key, no obligation, no expectations.
Yeah, I would add to that. I've talked to several people at Chevron over the years that occasionally call in with questions. We are more than happy to answer those questions, have the conversations, gotten to know some people, although they're not clients. Use this as a resource. We do this stuff all the time. You guys do it once. There are, do-it-yourselfer type clients out there. We absolutely understand. I enjoy a lot of those conversations with clients. So by all means, don't let that stop you from reaching out and having conversations about this stuff. Because as you see, I mean, this is stuff that we follow pretty thoroughly. Yeah. So looks like we're going to get to the end of the questions that are coming in. Just again, I think our objective today was to help folks understand what the segment rates are, how they have impact on the lump sum, on the pension plan. When you're hearing that comment in the hallways at the office, around the water cooler of like, hey, are you working for free? Am I working for free? I want you to understand what that means. And again, I want to point out that there's lots of mitigating aspects of the compensation package that may defray that. And realistically, for some people, the segment rates it's not something they should be worried about right now, because they've got their financial objectives are just far enough away that it's not something that they need to worry about. It's going to be much, much further down the road that they'll be dealing with that. At the same time, we do have some individuals, and we've had this happen in the past, where
we've identified that, yeah, if those rates continue to rise, it's frankly going to cost you money. It's going to actually cause you to be in a position where you are, in fact, working for free. We want those people to be aware of it. Maybe they continue to work, but maybe they don't. It's their opportunity to be informed and make a decision fully informed. So that's our objective today, is to help people understand a little bit better. And certainly if anybody wants to continue the conversation, you can see our contact information is up here. We are more than happy to have a chat. And certainly the door is always open. So we look forward to the opportunity. Chad, unless there's any other questions coming in, I think we can probably.
Yeah, I think, this topic came about as we were encouraged by actual clients to put this conversation on. So I would say if you guys have additional topics that you want us to go into and cover, we have dove into some of these in the past. Let us know. We're happy to go over what we know about the situation. And thank you all for your time. We try to be as efficient as possible with this.
Yeah. Wonderful, everybody. Well, thank you so much for attending today. Again, we look forward to the opportunity to connect with anyone who wants to continue the conversation. And certainly anyone who just even has a few questions about this, but maybe, diving into the planning process is not where they're at right now. We're still happy to have the chat with you. So again, very much appreciate your time. Want to let you get on with your day. And we look forward to the opportunity to connect at some point down the road. Okay. Thanks, guys.